My name is Matthew Bennett and I'm one of the senior investment managers here at NFU Mutual, been investing in the markets for around 20 years. So day to day, the fund managers are the people investing the clients' money. So they're constructing portfolios and maintaining those portfolios. So a starting point for that is to obviously understand the objectives of the fund and what type of investments are suitable. But it's not just maths and science, it is art and judgment as well. So we'll be doing research, looking at what's going on in the economy, what's going on in different sectors, what's going on at a business level. Then also we'll be trading, so we'll be buying and selling stocks for the funds. Most of that is electronic nowadays, so no one shouting buy down the phone. It's mainly electronic, but it's probably the last bit of what we do. There's really two types of investments. One is based around owning something. So if you buy a share in a company, you're buying a part ownership in that company. The other is based around lending money to someone or something. So a government bond, you're lending money to a government and receiving a rate of interest in return for that. And most other investments are all built around either owning or lending. What you choose to invest in will depend very much on your own objectives, goals and circumstances. So if you're 30 years old and you're saving for a house deposit and you're looking to buy within a year, you don't want to invest that money in the same way you would be looking to invest your pension, which you're probably thinking 30 years into the future. Cash is generally seen as a shorter term investment, and in recent years the rates of return you can get on cash or deposits have been below inflation. So you put your money away into a deposit account, get a small rate of interest at the end of the year. You can buy less with that money than what you could have at the beginning. So you're earning a negative real rate of return on cash. The alternative to that is to invest in more longer term assets like equities, like commercial property, like corporate bonds, which will hopefully achieve you returns above inflation over a medium and longer term. So 5 or 10 years ago, I would have said companies will probably progress, profits will go up, technology will advance, markets will produce positive returns. And they have done. Perhaps, if anything, they've produced stronger returns than we expected over the last 5 to 10 years. If we look forward, many of those things will repeat. But I would personally think returns will be lower than over the last 5 to 10 years because we've perhaps borrowed some returns from the future already. We have a range of funds that suit different clients' objectives that have stood the test of time. We've been here, we've been in the market for a number of years. So I think you can be confident from the investment side. I think it's as much about the company itself, to be honest. It's about the financial strength of the company, the service levels we offer, and our accessibility. We're there to explain and help customers understand what's going on. What matters is your own personal circumstances, and not just your circumstances, but your attitude. So it's really useful to have a one-on-one conversation with one of our advisors who can help relate that to your own needs and wishes.